Hey guys, welcome to Ron's Talks. I'm Ronald Anthony, and this is the first official video of the new playlist which I was telling you guys, the talk show series. I can say this is the episode 1, and in future you'll be witnessing such episodes. So make sure you stay tuned and you watch the entire episode. Okay, so for today's video, I have a really special guest with me, and as I said in the previous video, which if you guys haven't watched, it's there. The link, I think it comes on the left side. But as I said in that video, I won't be calling some big CEOs or some big shots or something. But that doesn't mean that this person right here hasn't inspired anyone. He has inspired me, and he has led a foundation for me into the stock market. And I'm sure even it will help you guys also to make your way or make your journey into the stock market, because it is really important and he is taught so much. So let's welcome my own uncle. His name is Rakesh. So for beginners like us, or for people who don't have a knowledge in the stock market, how would you define the stock market?
Stock is an asset class. If you're working, maybe you work from 9 to 6. So maybe it's for people who want some extra savings without their presence. Because morning you wake up at 7 a.m.
Yeah.
And 9 o'clock you reach your office, and by 6 your office work is over and you reach home by 8. But there is nothing extra you can do.
Correct.
So for those people, this is a best platform where maybe a 50% of the savings can be invested into the stock. And if it is kept for 10 years on a good quality stock, maybe the amount will get compounded, and maybe you'll do a better savings when you retire from your work life. And without your presence, you can do this. So that's a kind of advantage when you get into stock market.
So for some guys, just don't waste your time. I think that will be instead, I think they can save their pocket money or something, and then they can directly start off.
Some extra money. For example, if you're earning 20,000 per month, maybe 10,000 is your expense.
Yeah.
Maybe your rent, your personal expense, your travel. Make sure you cover it within 10,000. And
that's the
extra 10 is left off, of which 5,000 monthly you can just keep it aside and accumulate it. And when you have the crisis, recently we have this COVID crisis where the market fell a lot and there was lots of bargain. And during those times you can invest that bulk amount. So make sure you accumulate your savings, and when you get this kind of opportunity, you just put your money in and you can take advantage of it. But make sure you buy a quality company, not some steel companies or a cyclical companies.
Yeah, right. So, okay, now let's head into the major question. What made you get into the stock market?
Before getting into stock market, I was an engineer. So I did my engineering in Hassan, Malnad Engineering College. So I finished it. Kirik Party. Rakshit Shetty. So I finished my engineering, and then I went into I got a work in General Motors, GM, as a design engineer. I worked there for 5 years. And then at one point I read this newspaper. Those days the market was in peak. It was a bull market.
Yeah.
A bull is nothing but the top of a market. Everyone, Tom, Dick, Harry were investing in the market. So what I felt is, why am I missing it? Maybe I should make use of it, just like a general crowd.
Okay.
Later, when my brokerage account and the formalities got done, the market started crashing it.
Oh.
But luckily, one of my friend introduced to a book called BUFFETOLOGY. It's written by Warren Buffett's daughter-in-law.
Oh.
So that book helped me to get into market. And for my luck, that was the greatest correction, and the market fell almost 50%. The Sensex was 21,000 and it came to 8,000. And luckily, I got the book at that time. So that is when I invested my money. And I made 5x in 2 years.
Oh.
5 times.
Okay. That is great.
So that told me that is how I came to know the potential of the market. Without your presence, even though I was working in General Motors, but my income from market was more than what I was earning in General Motors. So that made me like focus on to the market.
So you said 5 times. So I mean, yeah, like for a person who just got graduated and got a job, and then I think that was like a lot of money. And
Yeah. And even the timing is important because when I got the opportunity, the market was bottomed out. Just what happened in during Corona.
Okay.
The Sensex came from 39,000 and it went till 26,000.
Yeah.
So the same advantage I had because everything was bottomed out, and the stocks like the HDFC Bank was available at 55 rupees, and now the HDFC Bank is 1,300.
Yeah.
Okay, and the same way Tata Steel, it was at 150, was the bottom price, and later it went till 500. Now it's at 300. Okay, so this is how like your presence is less, but you make sure you buy them and keep it for a while. So but my experience was less because as a general investor, I bought it and I sold it within 2 years.
Yeah. Okay. So next question is like, it is again, even though I know like for some months about after you told me about the stock market and everything, even after some few months and everything, this question still and always, I mean, it kind of like haunts me, I can say. Like, how much should you put? Like, is it too much? Should you invest too much or too less? Or how would you get to know? Like, for example, like putting 10,000 is okay, or putting 1 lakh is okay, or so such question is always there in my mind, and I'm sure for some of you guys also would be there. Like, for example, if you just have 1,000 rupees, and if a company X company will just take, if it's like 50 rupees and you have 1,000, so if you are thinking like, is 1,000 rupees enough? So I just wanted to clear that question.
No, it's not about the size of the money. Okay. See, initial stages when you don't have money, at least you get the experience. If you have 10,000 or 1 lakh or 1 crore or 1,000, it doesn't matter. But you have to make sure the 1,000 goes to 5,000.
Yeah.
So you get that experience. And tomorrow when you have maybe 1 lakh, and you'll know to make it 5 lakh. But if you have 1,000 and if it goes to 100 rupees, it means you have not learned anything.
Correct.
So it's better to stick with small amount when your experience is less. When you feel okay, you have mastered at least 50% of a professional investor, then maybe you can put the bulk amount.
Yeah.
Till then, you just need to read books. There are many books, but the books of a professional investors like Warren Buffett, Peter Lynch, Charlie Munger. So these are the investors, they have made billions. So you need to learn from a billionaire, not the analysts who come on TV. So
TV and all is simply, I don't know, like actually they just say like, okay, this can be the target. Like, for example, if it's 120, if it's starting at 120, and they just tell the target is like 158 or 200, but it doesn't actually.
No, it doesn't matter. See, it doesn't make sense also. For example, I told you HDFC in 2008. HDFC Bank was at 55, and if you have listened to the TV analyst, he would have given a target of 70 rupees, and you bought at 50, 55, and it went to 70, you exited. But if you look now, if you have held on to it, the 55 would have been 1,500. Okay, so like, the analyst would have like killed your fortune. Okay, so the best part is, see, no one knows what will happen. The HDFC could have gone from 55 to 45 or 35, but since it's a good company and it's India's #1 bank, and nowadays many like public bank, like government bank, the people are moving their deposits from government to private banks like HDFC, Kotak, like ICICI, Axis. So these four will do extremely good. So when the share price was at 55, so you think, okay, HDFC is going to do good. Put your money in that. It might go to 45. It's again a bargain because this company is going to do good.
Correct.
And in India, see, the population is 130 crore.
Yeah.
So the benefit is, and these people, most of them have their accounts in public bank, and some people still do not have bank accounts. So those deposits will shift from public to private.
Correct.
So HDFC will gain the market share, Kotak will gain the market share. All you have to do is buy them when there is a recession, when no one wants it. At 55, no one wanted HDFC. But during before pre-COVID, when it was trading at 1,000, 4,005, everyone bought HDFC.
Yeah.
And that went to 700 in March, 6 months back. And now it's again at 1,200. So the quality companies, they bounce back because of the earning power.
Yeah. So, like the most of like on social media or any other news channels or anything, we see that, okay, not just those, but many people, okay, see, since we are in India, I'm sure majority of the people's mind will be like, okay, don't put in the market, what if it fails? And oh, like why do you want to invest? Instead, put it in the bank, you'll at least it's safe. And what is your view on such kind of a mentality?
See, it depends on what you want. If you're happy with the 4% return, then you can put it in the bank. Okay. And see, your rent, your monthly rent, okay, every year it is increasing 5%. And your fuel charge, earlier the petrol used to be, maybe 4-5 years back, it used to be 50 or 60. Now it's 80, 85. So these expenses gonna increase. And if you put it in the bank, and bank is only going to give you 4%. So your expense, at one point, your expense will overtake your income.
Correct.
So that's why you need something better than this 5%. And the next option is mutual funds, where professional managers, they will put your funds into the companies. Maybe that will give you a return of maybe 10-11%. And if you're happy with that 10-11%, you can get into mutual funds. And you need not worry about your...
But that 10-11 won't be constant, I guess.
See, that can go to 15.
Okay.
In good times. That can go to 8 during bad times. But those are professional fund managers. You need to research. There are many mutual funds. And they have certain schemes, like a large cap. Large cap means big companies. And mid cap, small cap. So you have to... Even in that also you have to evaluate whether this is a mutual fund is aggressive or this is a defensive. So if you want a safe thing, go for a defensive kind of mutual funds like large cap. But if you want something aggressive returns, maybe 15% and all, go for a small cap and mid cap. So it's up to you. See, I want a return minimum of 20%. So stock market is the only option. Even see, you buy a house and maybe the house might cost you 60-70 lakhs and you give it for rent. All you earn is just 10,000 per month. If yearly it's almost 1,20,000. Okay. Just calculate for 10 months. Okay. So your 70 lakhs investment, it's giving you only just 1 lakh. It's giving less than the bank. Whereas if you put it in mutual fund, your 70 lakhs, the mutual fund will make sure you'll at least earn some 7 lakhs. But there is a fluctuation in market. So markets are a bit volatile and you need to put into a good mutual funds. But if you directly invest and if you are able to do it better than mutual funds, maybe you earn 20% or a 25% yearly you are able to earn. Maybe
that is more than
at the end of 10 years your 1 lakh is 10 lakhs. That's 10 times.
So that is, I think that will clear some of the mentality of, because majority, if we see, that is the mentality what they have. And even to be honest, like most of my friends and they said the same thing, not just them, like their parents, everyone basically said the same
90% population.
So they were like, no, why you lose too much, you lose that, you lose. So I think this answer would have satisfied for people who are having such mentality. Okay, now let's head into some history. So which was the major thing which you learned from which history, I can say?
History. See, charts helped me a lot because earlier I used to go through like 100 years old charts. So like starting from 1900 and see, in 1907 there was a crash. Okay, and market recovered after that 1907. And then 1914 till 1920 market closed for 5 years because the World War I had started.
Yeah.
And once the market opened in 1990 or 1920, it picked up and it ran for next 10 years, that is 1929. And there was a Great Depression where market fell 60-70%. And it took 20 years for market to recover from that bottom. Because those days, the policies were not so strong.
Correct.
See, nowadays, once the market falls, the government reduces the interest rate.
Yeah.
Government will fund banks.
That's how the bank's percentage came to
4%.
Yeah.
Okay, but those days there were no policy. So when the banks failed, the economy went down. There was no one to support the bank. So nowadays, especially when this COVID came, the government, before the market could fall down, the government started infusing funds to it.
Yeah.
That's why the market recovered very fast. So it fell 40%, now it recovered 40%. That's why you see this bounce back, because the market is now flooded with lots of money. And so from 1929 to 1945, market didn't go anywhere.
Oh.
That was a flat period.
Was
But individual companies did well.
Oh, okay.
Like Coca-Cola or some companies related to food, companies related to war, because there was Second World War. And people knew US will win Second World War. And after 1945, the market went up till 1962. Then there was a correction. And again, market recovered. It went up till 1974. There was a correction. And these corrections are like 30%. See, there will be minor 10% fall in between, but the major is 30% correction. And the next correction came in 1987, where market fell 20% in a day.
Oh.
Okay. And the same happened in March month. So this time market fell 10% in a day, and next day again 10%. And these are the record fall. So when you look at the history, you can figure out the patterns are similar to 1987. And from 1987, 3 days market fell, and from the 4th day it flattened, and from 5th day it started picking up. So now we see the similar pattern happening now. And 1989, 92, in India there was a Arshad Mehta scam.
Yeah.
Maybe in India, see, Indira Gandhi, she was shot dead.
Yeah.
Rajiv Gandhi.
Yeah.
Arshad Mehta scam. 1999 Kargil war. And 2002 the dot-com bubble, where all the internet companies
failed. Yeah, exactly.
2008 global financial. But in spite of all this, the market has made new highs. But what you have to make sure is you have to buy a good companies. They will fall, but they will come back when the market recovers. The same thing
I think
happened in March.
Yeah.
Good companies bounce back.
Correct.
Bad companies are still there. Yeah.
But that is the one thing I think people still, even till date, don't understand. Like, suppose the stock is falling, I think they'll just exit. They don't have the patience to
hold it.
Yeah. So that is the trick. Like, if you should just, I think you should just hold it.
No, if you know history and what has happened after every fall, if you go back, and after every fall, things have come back. But only good companies come back. Correct. There is a condition. Example, in 2003 to 2008, there was a company called Unitech. It went from 5 rupees to 5,000.
Wow.
Okay.
That's like 1,000 times.
Yeah, it's almost 5,000.
5,000. Oh yeah, sorry. 5,000. Wow.
And I know a person who put 5 lakhs, and his 5 lakhs became 25 crore.
Oh.
Okay, but that was a good company till 2008. Later, they ventured out into energy sector.
Oh.
The sector in where you need more money, more capital, and the government payment is slow.
Correct.
And they failed there. And this 5,000 rupees share is now trading at 1 rupee. So even these things will happen. So you need to watch out for what companies you buy. The same way, like HDFC Bank. Again, I'll take that example. 1998 it was maybe 10 or 20 rupees. And in spite of many splits, ups and downs, now it's still trading at a historic high.
Exactly.
So that's why I go for a quality companies. And since the people who don't have time to look at this, if you buy quality companies, you need not worry about the ups and downs.
Correct.
All you need to make sure is every quarter there will be a quarterly results. Just see if the quarterly result is improving. The moment it starts decreasing, just figure out why is it decreasing. Is it a temporary or is it a permanent problem?
So yeah, as you said, the quality companies like matter. Even actually, he's bought like quality companies, so I think you don't check every day or something.
No, I'll tell you one thing. See, today you go to a Nike shoe. There is a beautiful shoe which is available at 3,000 rupees. Okay, and tomorrow there is a discount. The same shoe is available at 1,000 rupees. The quality is same, manufacturing is new.
Yeah.
So will you buy?
Yeah, 1,000 rupees.
Yeah. The same you have to do in stock.
Oh.
If a quality company falls down, you buy more. But what people do is they start selling. Out of fear.
I think this point all of you should note, because as you said, once it falls, they just sell. But the quality companies, I think you should buy more.
Buy more if the valuation is correct. So see, the valuation I'll explain in a simple term. If I'm selling you an apple per kg at 1,000 rupees, will you buy it?
No, obviously.
It's expensive. But the same apple, see, right now the apple, I think it's per kg is 140 or 100 to 140.
Okay, yeah.
Same apple, if I'm selling at 60 rupees, you'll make sure you'll buy more. So in the market also same thing. See, the companies might trade at certain price. See, market is there forever. Maybe if you're not getting your price, a right price or a bargain price, maybe it might take 1 year, 2 years. But market will correct one day. There will be some problems, either financial, COVID, or a war. So there will be opportunity. Every 2-3 years you will get a discount. That is when you need to be aggressive.
So some of you who are thinking, who have thought like this should have been the perfect time to invest, and even I'm under your category. Even I have 0 rupees right now, but I want to invest. But I think, as he said, there will be some time.
You will get chance.
You will get chance, exactly. Okay, so another question. What I was thinking is, before and all, when you were telling me like the price.
Yeah.
Like I was thinking, it's just 50 rupees, or what, it's just 60 rupees. Anyone can easily buy. Yeah. But then you told me even that 60 is too expensive. Correct. So how do you value the price of a share or the company?
Okay. See, sometimes a 1 rupee share can be expensive.
Oh, yeah.
Okay. Sometimes shares, like example, Eicher Motors, they sell this Royal Enfield bikes.
Yeah, correct.
So that was trading at 13,000 during this COVID.
Yeah.
But that is cheap. Because see, Royal Enfield has that profit.
And these days, when you see, they'll be like, I want a Bullet, I want that, I want to keep.
No, they have a monopoly. And now since Harley has exited, so there is no other Bullet. And Honda has come up with its vehicle. But I don't think they will sustain. Java is gone.
Yeah.
No one is buying Java.
That was, I think, again a remake, like.
But it didn't do well.
Yeah.
Because it's under Mahindra, so it didn't do well. And see how you value a stock. Assume, example, a company. So we call it like a market cap. Market cap is nothing but how the entire company, what the entire company is worth.
If you guys want the complete description or the definition of market cap, there is a link down in the description. You guys can check it out.
Yeah. So market cap is like entire company. How much is it worth? Okay. So example, if a company is worth 1,000 crore.
Okay.
Or assume it as, we'll make it simple. It's 10 lakh. So if you have 10 lakh, you can buy the entire company.
Okay.
And I'll give you 2 options. There are 2 companies, each 10 lakh. So the seller A is asking 10 lakh, but his company is earning maybe yearly 10,000 rupees.
Okay.
And there's a B, seller B. His company is earning 1 lakh per year, and he is demanding the same. So which one will you buy?
The seller B.
Seller B. Because for a 10 lakhs, the company is earning a profit of
1
lakh.
Yeah.
It's almost 10% you're making.
Correct.
The bank is giving 4%.
Correct.
So that is how you evaluate.
Okay.
So there is a term called P ratio, where the price and the earnings. The P is the price and the E is the earning per share.
Per share. Okay.
So if price is 50 rupees and per share, if it's earning per share is 10 rupees. Like you pay 50, your share is earning 10.
Okay.
So it's a bargain.
Yeah.
But
correct.
if the same share price is 50, but the earning is 1 rupee, then it's expensive. Because for a 50 rupees, you're earning only 1 rupee.
1 rupee,
But if you
okay.
keep it in bank,
Okay.
for a 4% interest, bank will give you 2 rupees.
Mm.
So this is how you evaluate whether the stock is cheap. So this is one factor.
Okay.
Second, this 50 rupees share can go to 100, 200, 300, or it can come to 10 or 0.
Okay.
The probability of going to 100, 200 only when the earning is increasing.
Okay.
Example, if a company...
By earning you mean profits?
Profits.
Okay.
Yeah,
Profits.
profits and the sales. Okay. So if a company is able to grow 20%, your share will grow 20%.
Yeah.
And sometime in extreme cases where the market is in like high and everyone are buying, the share can grow more than the earnings. And during recession, during any crisis, the share can fall below earnings.
Yeah.
Okay.
That's
Even though, see, example, again I'll come to this HDFC bank. Their earnings were growing 22%. But during COVID, people thought, okay, the economy will never bounce back.
correct.
Everyone sold it. The same HDFC was available at the half price. It was trading at 1,300 before COVID, and during COVID it was trading at 770.
Oh.
So you are getting almost a 50%
Percent.
but the earning is same.
Correct.
And the bank is going to do well in future because now the monetarium is going on. So you have to buy at those time.
Yeah. I think that those kind of prices, like once in a lifetime.
Yeah, for investors like us.
Yeah.
But if you are a professional investor,
Okay.
see, there are two kind of investor. One is a growth investor who will buy only the company whose earnings keep growing.
Correct.
If a company is growing at 40% per annum, and maybe if the valuation is reasonable, he'll just buy it.
Okay.
He only looks at the growth, and when the company stops growing, he exits. That is one option. And the second option is when these kind of crises come.
Okay.
And the company valuation is very cheap, and there is no buyer, but the prospect, the future may not be now. In 2-3 years, the company is going to come with some innovations or some different product, which market is ignoring now. So if you have those kind of knowledge or information, and you feel this innovation will click, then you can buy it. So that is what you call value buying. So you buy companies which are undervalued, and you feel that this company is going to do well in 5 or 10 years. Not today, not tomorrow. So whatever it is, it's more of a long-term focus.
Correct. Okay, so before buying any stock of a company, what are the characteristics you should look into? Basically before buying the stock. Of
Buying it, right? See, it's just like you are buying a business. Okay. So before you enter into a business, you'll make sure this product doesn't have much competitors.
Correct.
Maybe it's free of competition. Okay. Second, you'll figure out who the person is running the show, the management, maybe the company owner, how the team is, whether the management is aggressive, whether they are innovating. And the main about the business is, for example, when you feel like having pizza,
Okay.
what comes to your mind? Domino's, okay. And when you want to paint your home,
Pizza Hut, you can opt for Pizza Hut, but Domino's.
Domino's is one which comes in India because their pricing is they are very aggressively priced, and their profitability is too good, and the delivery chain is excellent.
Yeah.
Okay. And the second, if you want to paint your home, which company comes to your mind?
Asian Paints.
Maybe the second is
Asian. That is only the thing which we.
But the first you remember.
Asian
Paints. Okay. The morning when you wake up, what you do first, you brush your teeth.
Yeah.
And what the paste you're using?
Colgate.
And once you take bath, what's the soap you're using? Lifebuoy. Okay. So all these products have some manufacturer and some owners.
Correct.
They do this. So these are essential products, and the demand for them is like evergreen.
Correct. It's for like forever.
Forever, because you can't live without these products. Okay. And even like example, right now the telecom. Earlier days we couldn't live without food. Nowadays people can't live without telecom.
Exactly.
Okay. So you need to figure out in these sectors who are the leaders. Example, if you go to telecom now, Jio or Bharti Airtel,
correct.
they are
Those
the
two are
leaders.
the leads. Yeah.
And one more thing, this is not the recommendation.
Yeah.
This is just an
This
idea
is-
how you evaluate a business.
Correct.
So whatever we discuss, it doesn't mean that you need to go and immediately buy it. You do your research, and if you feel this company has done good, will do good, then it's up to you.
And also, just don't go behind like if some huge person like for a very big investor has bought, it doesn't mean like even if you buy, even you'll get the same returns or something.
And see, everyone buys on their research.
Yeah.
Maybe I see something, maybe that might be something foolish also. The end result will be known after 5 or 10 years, whether what I figured out, whether it's correct or not. Okay.
And it's always not like it's a positive thing. Even we'll make mistakes. Even we can make mistakes. That's not
the mistake will happen.
Exactly.
The more you get experience, the mistake get reduced. See, ultimately, you forget about the good companies. You avoid bad companies, you'll end up doing good. Avoid companies which are very cyclical. Cyclical in the sense like a metal companies, which you don't need day-to-day life. Or like automobile companies, to some extent they are cyclical. But you should avoid those companies. And the safe company example, when you come to noodles, there are only two players. One is Sunfeast and Maggi.
Nestle.
All Indians, that's the easiest way to prepare. So who is making money?
Nestle.
And the second option is ITC. And ITC sells a cigarette.
Yeah.
And he is a leader in the cigarette segment. So you need to identify these companies. But at a right price. Not at just any price. Okay, these are good companies, I'll start using it. Because sometimes if they are overpriced, example...
Basically now, actually they're overpriced.
They are overpriced.
And you won't make much money, I guess.
Because same thing happened. In 2002, Nestle, Hindustan Unilever, these companies were overpriced. For next 8 years, they didn't go anywhere. The prices were same, stagnant. Later, 2011-12, when the stocks were cheap, things crossed the share price. Then the people started buying it, and ultimately now it has reached peak level. I feel that the valuation is very high.
So when it is in that kind of a level, I doubt you'll get so much of returns.
No, you won't make
much money.
You're just wasting your time.
Correct.
Sometimes it's better to keep in back. So you need to evaluate. And
so basically, what you're saying is we should find out companies which is going to be like next or Nestle or
not
something like that. Or?
Yeah, one is that. See, you need not think about Nestle. Nestle is doing good. Okay. Hindustan Unilever, the Sunsilk shampoo, Surf Excel, Lifebuoy, all these are under. But there are people who supply packing materials to these guys. So when these guys do good,
them we should catch up.
So Nestle, they have already grown up. But now you have to figure out who are the suppliers to these guys and make sure they are profitable. The profits are good, and if they are at a reasonable price, then you can go ahead. But if a company has a barrier, like example, like a Maggi, no one can enter.
Correct.
Especially in the shoes market, Bata is the first thing which comes to your mind. And second, that Relaxo and others. So always go for a top 2 companies, leaders of that sector. But avoid cyclical companies.
Correct. Okay, you said cyclical companies. Can you just elaborate a little bit by giving some examples?
See, cyclicals are the companies like they do good in good times when the economy is good, when there is demand, like example metal companies, mining, cement, and real estate to some extent. So these are cyclical companies. They will only do good during good times, but in the bad times they do extremely bad. Example, see right now I have this Tata Steel. Maybe you can show your viewers the chart. Okay.
So I guess you all can see the chart right now on the screen.
Okay. So if you look at Tata Steel, I remember 2008 I had purchased when there was a global recession, financial recession.
Okay.
So I had purchased this company at 200 and it went down to 150. I purchased few, and my average buying price was 170. And within 2 years, the company went up to 500.
Oh.
Okay. So anyhow, I wanted to buy a car and I just exited and I bought the car. But now if you see, the same company is trading at 360.
Oh.
If I had kept the money for the from 2008 to 2020, it's almost 20 or 12 years.
Yeah.
And if I had kept the money there, my money would have been same. No returns.
Exactly.
So if you do
no
those
use.
kind of, if you invest in those kind of cyclical company, the stock market is risky. That is one example. And the second example, again, the HDFC Bank.
Okay.
See, because see, why I'm repeating HDFC is because everyone knows that company.
Correct.
So I want to go with example which people see in their daily life, and this bank is visible everywhere.
Correct. Correct.
So imagine HDFC was at 55 rupees and the market corrected, and now it is at 1,300.
Yeah.
So it's almost 20 times the same money, but there is a difference in the return. If I had put 10 lakhs in HDFC, that would have been almost 20 times, 2 crores.
Oh.
Okay, but the same money I put it in 10 lakhs and
Correct.
Tata Steel, it would have been just 20 or 30 lakhs. Where is 2 crores?
Yeah.
And where is
30?
So your duty is to identify these companies during your weekend. Maybe Monday to Friday you work for some company. Maybe during weekend you just see which company's earnings are growing. And see, stock prices only grow when the earnings grow.
Correct.
When there's a growth in the income. And HDFC, they were able to generate net profit, and the profit was growing every year at 20 to 25%. That's why the share price was growing. Whereas Tata Steel, 3 years they did good. It went to 500, and next 3 years it came down. The earnings came down, stock came down.
Correct.
So stock price is a reflection of the earnings.
Okay.
If company does well, if the profit grows, the share price will follow. That's it. But people, they want adventure. They try to get into this cyclical company, and then they blame the stock market is risky.
Exactly. I think because they see that sudden sharp increase in the stock, that's why I think they just...
And they don't enter at the bottom. Not at the bottom. When the share prices are reasonable or undervalued, people fear. People fear the market further down.
Correct.
So, but they are aggressive when the market is at the peak. For example, like in Tata Steel, if you go in 2008, it was trading at 850 rupees.
Okay.
And if you had bought at that peak level, you would have never recovered your money. And example, the Unitech, it was at 5,000 rupees. But the people are more energetic when they see the share price. They think this 5 will become 10,000. That is greed, and you need to have control over that. And that 5,000 now it's trading, Unitech is trading at 1 rupee. So you need to avoid these kind of adventurism and buy only when they are cheap. Okay, so that is how you make sure. See, you avoid your downside.
Correct.
Upside is taken care by market. You make sure you avoid all this garbage companies.
Correct. So finally concluding this awesome video, what is your future view on certain companies? Like, what is your eye on certain companies, I can ask?
See, the blessing which India have is a population.
Yeah, correct.
So there is a 130 crore population, and India has the youngest population if you compare to worldwide. Okay.
Correct.
And anything you do, there is a demand. You need not export it. You have a local consumption. People here itself will consume it. Okay. Exactly. Only 2 players are there, Bharti and Jio. Tomorrow, if they charge you, like monthly you have to pay 1,000 rupees, you have to pay because now you are addicted.
We will pay actually.
Because now, see, in this lockdown, telecom was the only thing which helped you. Internet. And next time everything is going to be internet. And the work from home concept. That is going to
That is
do
the
good.
main.
And see, right now the pharma companies are doing good. But they will do good to some extent. Okay. Because in US, right now the FDA norm. FDA is a board which gives you the permission to sell your drugs.
Correct.
And now they have relaxed because of the COVID. And now many Indian companies are getting the license to export or sell their products. So now the pharma companies will do good. But after a few years, there will be oversupply of pharma.
Correct.
So at one time, this is going to saturate.
Okay.
So you need to time it. So better going into those companies. Better get into a safe companies where only one or two players do good. And make sure you buy when there is a correction and a deep correction.
Correct.
And every 10 years market falls 8 times. There is a 30% correction. So every 2 years you'll get a 30% correction. You just need to wait for it. Or accumulate your cash, read books, educate yourself. So that is how you time it.
So finally, what would you like to say to our viewers? Like, what is your final, like, a tip or something like that?
See, if you have patience, the market requires patience and dedication. I can give you one example. See, when I started pre-COVID, like almost 10 lakhs I had put into the market, and this almost went till 6 lakhs. The market fell, my 10 became 6. So these companies gonna bounce back. And now my 10 lakh is now 12 lakhs. Already I am in 2 lakhs profit.
Yeah.
With this COVID. Okay. So it's for a people who can digest these kind of risks. And the market is not a straight journey. Buy at 10 rupees. Before going to 100, it will go to 20, it will come to 15, it will go to 50, it will come to 30. So the journey is up and down. So if you can digest it, then the market is for you. But if you can't digest it,
exactly.
if you have a sleepless night, sorry, I can't sleep, bro. Like, I'm frightened tomorrow, what will happen? No, then market is not for you. And especially, see, this is for people like who wants a free time. Example, see, you have a monthly income. You work somewhere and monthly you earn so and so.
Okay.
That amount will take care of your daily expense, your basic expense. And this is an income. This is like a wealth creator. You want crores in 5 years or 10 years, then this is the place. If you want to earn crores, then only you come to market. If you want to make few thousand, then you just avoid it. And you need to dedicate yourself. Read a lot of books and watch professional investors' video like Warren Buffett. Watch their interview. Maybe some good ideas might pop up and it might work out for you. If not, just put it in savings account. Simple.
Simple, safe.
Yeah.
Okay, so anyways, I hope you guys enjoyed this video, and I would like to thank my uncle and thank you for sharing.
Thank you for inviting me. And anyhow, I'm not a professional investor. Just see, anyhow, I'm into a business and I have a steady income. And that business is taking care of my monthly expense and my basic luxuries. Okay. And the investing is just for a wealth building. After 10 years, I want 10 crore or 100 crore in my account. That's why I'm doing this as a side income.
Correct.
So it's better because the market, you cannot come in and come out tomorrow. The more longer you keep, example, I told you HDFC Bank, it was at 55, now it's at 1,300. But do you have the patience to wait for 10 years? So that is when you make big money. The longer you hold it, you make big money.
You guys can highlight that word. The longer you hold it, I think that is when you can make.
But longer, the good company.
Correct. Yeah. That is it. So that is it, guys, for the first episode of the stock market talk show series, I can say. I hope you guys enjoyed this one, and we'll catch you in the next one. Thanks for watching.